Hello friends, welcome to our class. In this class, we would be talking about the balance sheet, its contents and the format. In our accounting equation session, we have seen that almost all the transactions of an organization has an impact on the financial position of that organization, and this we have seen by way of working out that illustration, right? So since it is not feasible to draw a balance sheet after each and every transaction, it is usually prepared at the end of a specific period, which in case of Indian companies would be as on 31st of March every year. You will find many companies preparing interim financial reports, which are the quarterly statements or even half yearly statements you'll be finding. But by and large, the actual balance sheet numbers you get only after the year end, because you have many adjustments that happen after the end of the year. So talking about the contents of balance sheet, as we have seen or we have understood that balance sheet is nothing but a report card of the company's finances. Assuming there is a guy who is in standard 10, how would his report card look like? He would be having a subject called, say, maths. He would have science. He would have social studies. He would have computers and, say, languages, English, Hindi, or other regional language, right? So if we talk about the report card of a student, he would be getting some marks out of, say, 100, or he would be getting, say, grades. What we do is, based upon this report card, we analyze his position as compared to the other students of class 10. Right. Similarly, in case of the balance sheet, which is the financial report card of an organization, we have five things. See, you need to understand these basic five things: assets, liabilities, capital, income, and expense. See friends, if you want to really understand the accounting in the simplest manner, you need to understand these five things. These five things are the pillars of accounting, and you won't find any transaction beyond these five accounts or five types of transactions. The first is asset. As we have seen, asset are all those things on which a company has a right to use, right to dispose of, right? Then you have a liabilities, which means we have seen it's the obligation to repay in future. Then you have capital, or we also call it as equity. Capital is the amount invested by the owner in his business, not others' business. Then you have income. Income is the revenue which has been generated due to business activities, or even the activities which are incidental to business. And expense is the amount paid, or the charges, or the cost incurred for running this business. Very simple. So in accounting world, if you are clear with these five terms, I don't think there would be anything which would be bothering you throughout the accounting sessions anywhere, right? So you need to understand these five things, and these five things we have also seen by way of our accounting equation, wherein we have said that asset is equals to liabilities plus capital, and in capital we make adjustments for income and expenses. If income is greater than the expense, you have a profit which adds to your capital goes up. If the income is less than your expense, then it is a loss which would reduce your owner's equity or owner's capital. Clear? And we have seen that this is the balance sheet equation, which means in order to understand the balance sheet, this is also called as accounting equation if you remember. So in order to understand the balance sheet, or in order to understand the accounting, you need to know the accounting equation, or all the elements which go into the balance sheet preparation, presentation of a balance sheet, right? This is how the traditional format of balance sheet looks like. This is applicable in case of proprietors. This is applicable in case of partners or partnership firms. In case of Hindu undivided family accounting, or in many cases in case of society, you find this type of balance sheet. What is there in this form of balance sheet? You have two sides, one on the left side, the same thing is replicated on the right side. You have amounts for these two. On the left hand side you write equity and liabilities, and in many books or some authors write assets on this side and liabilities on this side. Whatever be the case, all you need to do is you need to write assets on one side, liability and equities on the other. Why? Because we have seen that the accounting equation is nothing but asset is equals to liabilities plus capital, which means on one hand you need to write assets, on the other you would be writing liabilities and capital, or equity and liabilities, right? Whether you write assets on this side or liabilities on this side won't make any difference. The next thing that you need to understand is the total of these two should be equal, as we have seen in our accounting equation class, that after each and every transaction the total on both the sides, the left hand side as well as the right hand side, would always be equal. So what are the components that go into the balance sheet? These are five elements. Capital, reserve also forms a part of capital. Then you have liabilities. These liabilities may be payable to the long-term providers or short-term providers. Anything which is to be paid after a period of 1 year is called as a long-term liability, and within the same accounting year or for a period of less than 12 months would be termed as short-term liability. Or current liability and non-current liability, these are the terms which are being used these days. Both have the same meaning. On the asset side, again you have current assets and non-current assets. Non-current assets are those non-current assets are those assets which have a life of more than one accounting year, right? And current assets are those assets which are readily convertible into cash, or which are convertible into cash for a period of less than 1 year, are called as current assets. The examples of current assets are, say, cash at bank, cash at hand. And the examples of non-current assets would be land, building, plant and machinery, furniture and fixtures, things like this. These are our current assets. Stock is your current asset, debtors are your current assets. Receivable, again the current assets, like this. So you need to understand only five things which needs to be mentioned. The reserve here which is mentioned here is nothing but your profit portion. Current profit plus accumulated profit or undistributed profit. What happens in case of a company is, whatever profit is earned, that can be used in two ways. One would be to distribute that to the owners of the organization like the dividend. The other would be keeping that for the further growth and development of organization, which is called as a retained profit. So the total of retained profit of the current year and the past years would be recorded or would be shown as reserves. This is your capital. This is your difference between income and expenditure. This is capital. These are liabilities, and here are assets. So I said that you need to understand only five things. One is asset. The other one is liability, capital, income, expenditure. That's it. So if you go through this balance sheet, you will find that there is no term in addition to these five terms which we need to understand, right? So we would say the contents of a balance sheet are assets on one side, liabilities and capital on the other. Then we would say income and expense be adjusted with this. If your income is greater than the expense, your capital would go up, else it would go down. Now, this is the format which was being used in the traditional format, or for those companies, or for those entities which are not listed in the stock exchange. But those companies which are listed in the stock exchange needs to present the balance sheet in a slightly different manner. You divide this whole into two parts. Here you would write equity and liabilities. Then you would write assets this way. So what was happening earlier, the horizontal format. On the left side, you write liabilities and equity. On the right, you write assets. Similarly, the format has been changed recently. Now, the companies are supposed to prepare the financial statement or balance sheet in vertical format. What is vertical format? You have equity and liabilities on one hand and you have assets on the other, and the rule again would be the same, that the total of these assets and liabilities should be always equal. This would be the total of equity and liabilities. This would be the total of assets, which means here you would have capital or equity, you have reserves, you have non-current liabilities, you have current liabilities. Here you would have non-current assets and you have current assets. The total of this all should be equal to this total. That's it. So the format has been changed, but if you see, again you have only these five terms: asset, liabilities, capital, income and expenditure. That's it. So the format has been changed now, or the companies use a different format, but the rules would be the same. The items would be the same, the contents would be the same, right? Now let us have a look at the balance sheet of one of the companies. Say for example, the biggest company when it comes to market capitalization in India as on date is Reliance Industries Limited. Now let us have a look at the balance sheet of the Reliance Industries Limited, just to find out as to what are the elements which are going into the balance sheet, right? Now, if you see, this is only half portion of balance sheet, because the complete balance sheet may not be, it may not be proper to fit in the complete balance sheet in the same slide because of its length, right? So what I have done is I have broken the balance sheet into two parts. The upper portion is shown here. The lower portion of the balance sheet, which is comprising of assets, would be shown in the next slide. Now see how the companies do prepare the balance sheet at by them, right? So here if you see, you have the numbers for the year ending 31st of March 23. Then you have numbers for 31st March 22. You have 31st March 21, 31st March 20, 31st March 19. So Reliance Industries Limited is presenting the balance sheet in a comparative manner for the previous 5 years. Generally they do it for 2 years, current year and previous year. But here I have just shown you that how the balance sheet can be prepared even for a period of 5 years. So this is the basic benefit for preparing the financial statements in a vertical format. In horizontal format, you did not have this flexibility. So this is one of the reasons why the balance sheet has to be prepared in vertical format, so that you have comparisons for all the numbers across different years. Since the numbers for a particular year may not give you a clear idea of the financial position, what you need to know is you need to know the numbers in relation to something else. It can be the comparison of Reliance Industries with Tata Steel, the comparison of Reliance Industries with Wipro, or the comparison of Reliance with Reliance itself. Previous year's Reliance numbers plus current year's Reliance numbers. Then only you will be in a position to know as to where the company is heading, or what is the financial strength of this company as compared to the previous year or as compared to its competitors. Right? So that is the reason why we prepare the balance sheet for a period of more than 1 year. This gives you the comparisons. And again, if you see, you have only these 5 elements: capital, income, expenditure, liability, and balance sheet. That's it. Where is capital? It is shown here. Equity and liabilities. You have the capital here. Where is the profit? It is here. The profit is. It is income minus expenditure, or excess of income over expenditure. Then you have liabilities. All put together, your total capital and liabilities would be this. What they have done is they have shown the capital here, they have shown the reserves and surplus here, they have shown the liabilities broken up into non-current here and current here. This is the current liability portion, this is the non-current liability portion, this is the portion of profit, this is the portion of capital, this is the portion of liabilities. So here you have equity or capital, you have income and expenditure, you have liability. What remains is assets. The other part of the balance sheet would also have the same balance here. Just remember these numbers so that when we go to the next slide, we can just have an idea. Remember this number 890,565. Look, 890,565 is the total of the assets here. So we would say the total of assets has to be equals to total of liabilities plus total of capital. Total liabilities means non-current liabilities plus current liabilities. Capital means the owner's equity and the reserves. If this is negative, this capital would go down, that's it. So the components of a balance sheet are nothing but these 5 elements, which are equity, income, expenditure, or the difference between these two called as profit or reserves, then liabilities, and then assets. All you need to understand is these 5 things. So these 5 form the components or ingredients with which a balance sheet or a report card depicting the financial strength of a company is prepared as on 31st of March every year. Right? So with this, we conclude this topic by saying that balance sheet is nothing but a report card which is prepared at the end of the session, which is 31st of March every year. Then the ingredients would be assets, liabilities, capital, income and expenditure. When is it prepared? On 31st of March. These are the ingredients. How it is prepared? Horizontal or vertical. How is it what is horizontal? This is the horizontal thing, wherein you have equity here, the difference of profit and loss, which is called as reserves. Then you have liabilities. Here you have the assets, income expenditure. So 1, 2, 3, 4, 5. How do you present that in a vertical manner? Again, you write it like this. On the top side, you have equity, income expense difference, which is called as reserves. You have liability. Here you have asset. The total of this should always be equals to this. If that doesn't happen, which means you have done something wrong in your financial recording, because of which the balance sheet, the total of the balance sheet is not matching. Right? So this is all about the balance sheet and its contents. Thank you so much.